Has it ever happened to you that you took your time, did your research, asked like 50 people, invested, and then it started declining? Sounds familiar? Hello again. Welcome back to Wealth Waltz with Walunj, the show where you and I will waltz our way into the mysteries of building real wealth, one episode at a time. I'm your host, Sandeep Walunj, man from Motilal, Oswal, and we are getting into something that has probably bugged all of us at some point or the other. Why do investments decline just after you invest? So what causes it? Is it the market out to get you? Well, not exactly. Today, I'm going to let you in on a little secret. It's not always bad luck. Sometimes it's the stuff that we do without even realizing it. That's causing the decline. Let's dive into it because I promise you will want to hear this. First up, the behavioral reasons. You know that feeling when you finally pull the trigger on an investment and you're thinking, yes, that is it. But just as you feel like you're winning, your portfolio starts tanking. And that's because something called behavioral biases. The Dalbar quantitative analysis of investor behavior shows that individual investors tend to underperform the broader market because we wait for the signs or positive momentum before investing. You're waiting for that confirmation, right? Is it the right time? Am I not making a mistake? But by the time you decide and go for it, the market has moved on, pricing in the growth and leaving no room for immediate upside. The second one is following the herd. Everyone is talking about a hot stock or a mutual fund, and suddenly you think maybe I should jump in too. It feels safe, right? But guess what? You might just be buying at the peak when everyone else is already riding high, which leads to mass investing. And what happens when crowd starts taking profits? Yep, that sudden drop. You essentially bought at the peak when the optimism was sky high. So when a correction came in, your investment dipped. Just like that. And here is another one, the recency bias. And this is the sneaky one. When a stock or a fund has been doing great lately, it's tempting to think that it's going to continue with the same performance and therefore it's a safe investment and ignore the risk rating. You get lured in and surprise, surprise, those gains vanish faster than your phone battery when you need it the most. Investors often ignore the risks and keep buying into a stock after it has had its big run. And guess what? In stock market, it's not a guarantee that it will keep rising. Then there is a fear of loss. When the market is uncertain, we freeze. We wait for that perfect moment, that signal, that voice which says it's safe now. But by the time you pull the trigger, the market has already moved on, leaving you with very little room for gain. But hey, that's not all. Sometimes it's the overconfidence that lets you in. It's called the market timing bias. You have probably heard the saying, buy low, sell high, right? But what does it actually mean when the market is jumping up and down like a roller coaster? We are all hoping to time the market perfectly, but spoiler alert, it's nearly impossible. You might actually get in when the valuations are sky high and then bam, you see that immediate dip. What happened? Well, that's the nature of the beast. Markets are volatile and short-term fluctuations are normal. The timing just wasn't on your side. Then there is a concept called mean reversion. What does it mean? It means that a data set over a period of time will revert to its mean or long-term average, which means that prices will drop after a run-up and what seemed like a hot pick at a point in time will suddenly feel like a dud. If you were chasing that short-term momentum, you might feel that your investment has underperformed right after you made it. But spoiler alert, that's just the market finding its balance. And many times it's not just you. There is a phenomenon called profit taking by other investors, which also plays a huge role. When things go up too quickly, people start cashing out, triggering a little bit of market correction. Even the big institutional investors do it very often. They rebalance the portfolios, sell overvalued assets, and buy undervalued ones. And that is why the market can feel like a roller coaster when you're just trying to chill. So, what do?
Don't panic. I'm about to share a few hacks on how to handle these dips like a seasoned investor.
First, invest based on fundamentals and not the hype. Look at the intrinsic value of your assets rather than the recent performance or trends. Look at the company's valuation, earnings growth, and future outlook. Is it a solid long-term investment? Then go for it. Next, consider using SIPs, the systematic investment plans. Instead of investing a lump sum, SIPs let you invest a fixed amount periodically. This helps you ride out the market volatility and reduces the risk of making poor decisions based on short-term price swings. Next is research and diversify. Don't put all your eggs in one basket. Spread your investments across sectors, asset classes, and geographies. It reduces the impact of bad timing in one area. Next is stick to your plan. Align your investments with your goals and the risk tolerance. Don't let short-term volatility dictate your strategy. Stay consistent and patient. And most importantly, give up on trying to time the market. Trust me, it is nearly impossible. The market doesn't care what you think about it's going up or down. Focus on staying invested and staying consistent. So the next time the market dips right after you invest, remember to stay calm, stay disciplined, and stick to the fundamentals. And that's a wrap on today's Wealth Waltz with Walunj. Trust the process and let the long-term growth work for you. Remember, it's not about timing the market, it's about spending time in the market. If you enjoyed the episode, hit the subscribe button, please comment with your doubts, and I'll try and answer as much as I can. I'll see you the next time as we keep waltzing towards smarter, wealthier investing. Catch you soon.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.